Investors become more interested in the commodity complex as a means of diversification. It's good to recall one of Peter Lynch's sayings: invest in what you know. What is known about individual markets' real supply and demand situations is seen in forward curves, as well as basis, price difference between cash and futures. In the grain and oilseed sector, one of the markets that could still be most attractive to global investors is soybeans, given its long-term fundamental outlook. Like all of us who have been in the investment/trading world for decades, American investor Peter Lynch had a number of sayings he would sprinkle through his interviews and writings. One that I still remember is, invest in what you know. As you likely recall, I've written recently how global investment traders looking to diversify into commodities have a smorgasbord of bullish markets to choose from, based on inverted forward curves, bullish long-term fundamentals, alone. In fact, a stroll through the global oilseed sector alone gives these investors 5 solid choices, as Malaysian palm oil, canola, soybean meal, and soybeans all boast inverted forward curves. Recent news has been of India ramping up its purchases and imports of U.S. soybean oil, with the latest weekly export sales and shipments report showing the country holding 20,000 metric tons of unshipped sales, as compared to none last year, and 92,600 MT shipped, versus last year's 36,000 MT. The market offering the most liquidity, using trade volume and total open interest as a measure, is soybeans. This raises the question, how much can investors know about the global soybean market? I know there will be plenty of squawking about data from USDA providing the answer, but only for make-believe investors interested in imaginary numbers. On the other hand, by studying the CMDTY National Soybean Basis Index, ZSBAUS.CM, and futures spreads, we can know everything necessary to make our decision as to investing in soybeans. Starting with the NSBI, Tuesday afternoon's calculation came in at 46.0 cents under March futures, holding above its previous 5-year high weekly close for this week of 46.4 cents under. This tells us the domestic supply and demand situation remains tight despite first-of-the-year cash sales that have been made. Then we have the market's forward curve that is basically inverted from the May 2022 contract through the end of the 2023 to 2024 marketing year. Note, though, the key May-July spread has seen its inverse weaken of late, a result of increased hedging tied to South American producer hedging. This spread would have to fall to near its lifetime low of 8.5 cents carry before no longer covering a bullish level of calculated full commercial carry. That isn't likely to happen, so the bottom line remains the same: South American production isn't going to be enough to loosen the tight global supply and demand situation. As an investor, then, soybeans look like an attractive market to move money into based on what we know about its long-term fundamentals. But there are a couple bearish factors as well. First, the market has already seen a strong round of non-commercial buying push its net long futures position to nearly 210,000 contracts, blue line on chart. Even if fundamentals stay bullish, this group could reduce its position at some point, leading to a sell-off in futures. Then we have the long-term trend of the CMDTY National Soybean Price Index, the intrinsic value of the market, that completed a major spike reversal on its monthly chart last May. This tells us that at least technically, the long-term top is in at $17.7668. However, global investors may have learned from the legendary Oracle of Omaha, Mr. Warren Buffett, with his famous quote on technical analysis: "I realized that technical analysis didn't work when I turned the chart upside down and didn't get a different answer." Lastly, there is Newsom's market rule number 6 that tells us, fundamentals win in the end. If this holds true, the top posted last May by the NSPI might not mean much long term.